This is level 2 of the CFA program, topic 9, quantitative methods, and the reading on probabilistic approaches, scenario analysis, decision trees, and simulations. Scenario analysis is a useful tool to make capital budgeting decisions, to try to estimate interest rates or inflation in a macroeconomic environment. Decision trees are useful to value fixed income securities, especially those that have embedded options. And simulations are useful tools that can accomplish those same kinds of decisions, but a whole host of other decisions out there inside of the financial framework. In fact, you can run a simulation on just about anything, and you'll see this and its importance as we look through these learning outcome statements. Notice that each one of the LOS has the word simulation in it. And so these learning outcome statements could probably be summarized in one LOS, right? And that LOS would sound something like, you need to know everything about simulations. Let's go ahead and do a brief recap of what we probably know from our previous discussions. And by the way, of course, simulations are going to require, computer resources and algorithms and software. And so it pretty much lends itself to being the next step in this series of steps in these topics in which we did machine learning, and then we did big data. So it makes sense to come and have a conversation on simulations. All right, look at that first diamond point. Scenario analysis and decision trees gauge the impact of discrete risk. Remember now, discrete risk means, every so often, like every week or every month or perhaps every day. But simulations are used to measure continuous risk. And of course, with that continuality in there, that's not a word, but that continuality in there is going to depend on and be a function of correlation risk. And we'll talk about that in a handful of slides. That third diamond point is probably important there. Continuous risk is more reflective of the real world. Interest rates, inflation, and a lot of macroeconomic variables and variables inside of internally within a corporation are continuous, which means they can take on, almost any value within some kind of a reasonable range. And so there's a little picture over there on the right of a decision tree. So we start at node 0. That's today, and we want to make a decision based on something that we think is going to happen in the future. So we have two paths. So this is a simple decision tree where we can either go up or we can go down. So interest rates could go up, interest rates could go down, prices could go up, prices could go down, revenues could go up, revenues could go down. All sorts of ways to apply a decision tree. Let's look at that first really super important LOS. Describe the steps in running a simulation. This sounds like a really good exam question. And to do this, what I want to do is work through an example, perhaps throughout this entire slide deck. Let's suppose that we're a company that makes boats, like a Malibu boats. Have you ever seen one of those Malibu boats? They're super, super cool. And so let's suppose that Malibu Boats is making the capital budgeting decision to expand its product line to include golf carts. And so what Malibu Boats will do is run some type of a simulation. Now, here's the really challenging thing about this. So they have one product line, boats, right? Boats go on water. Golf carts, that's transportation, right? Just like a boat, but it goes on land and it's used for a specific purpose, on a golf course. Now, it doesn't have to be limited to golf. It could be a hunting cart. It could be a farming cart. It could be any kind of a cart. But clearly, there's a relationship between having the skill set and the ability to be a successful branded product line in the boat industry and having that success be leveraged over into the golf cart industry. All right, so let's look at some of the steps here. Determine probabilistic variables. All right, so number of variables that can be allowed to vary in a simulation is unlimited, but of course we need to squeeze that down because you don't want to throw infinity into the algorithm because it probably won't be able to handle that. So you want to find a few variables that are significant. So what does that mean? What are variables? How are we going to make that golf cart capital budgeting decision? We're going to say, except if it has a positive net present value. Well, of course, what do we need for a positive net present value? We need to compute operating cash flows, and we need to compute the weighted average cost of capital. So inside of those cash flows, we have things like revenues, we have things like expenses, right? We have depreciation, we have tax, we have all that stuff in there. And then on the weighted average cost of capital side, we have, market value of debt, market value of equity, we have beta, we have default risk, we have maybe a risk-free rate of interest, we have all that stuff, right? So what we want to do is try to focus on those few variables that will have a significant impact on the ultimate decision. Now, for each variable, we're going to use either historical data, cross-sectional data, or some kind of statistical distribution that we'll talk about here in just a second, depending on the type of risk. So we need to estimate, we need to figure out and define those probability distributions for each variable. I mean, the simplest of all life would be that, hey, our revenues are normally distributed and our expenses are normally distributed. And that may be the case, but it might not be. How about if we check for correlation across variables? It can be estimated using historical data. We've done that for a long, long time, right? So if we have high correlation, then we have two choices. We can eliminate one, select the one that has the higher impact on value, or we can model the correlation explicitly into the simulation. Now, there's another LOS regarding correlation. I'll come back and talk about this in just a second. But if you go to the reading, there's really just one sentence about the model the correlation explicitly into the simulation. So I couldn't let that go. And so I did a little bit of research on that. I'll share that with you in just a minute. But anyway, the important step here is to check for correlation, identify the correlation, and then solve the problem of correlation one of two ways. All right, step 4, we're going to run this simulation. So we have all of these variables out there. Think of them almost as like silos. Remember we did silos back in when we were trying to do some kind of risk management, right? So we have a silo for revenues and expenses and beta and inflation, all those things. So what we're going to do is just reach our hand in and pick one out and throw that into our capital budgeting model, and then go ahead and say something like, okay, let's compute net present value. And then we reach our hand in and do it again and do it again. And now, of course, if we were doing this physically, it would take a really long time to do this. Think of how long it takes to play a game of bingo. But of course, the algorithm is going to do this over and over again so that you can, can I say this, relatively easily get to tens of thousands and maybe even hundreds of thousands. I took my students to New York City years and years ago. We try to do this annually, but we met with a currency trader one day, and he was telling us about the simulations that he runs. And he said he goes home at night, he presses a button, and then when he comes in the morning, he's got 10,000 outcomes so that he can trade during that next day. All right, so we're going to perform all these simulations. The number is going to depend on, how many inputs. So if you go back to our Malibu Boats example, we probably have lots and lots of inputs because Malibu Boats has been around since, let's say 1980. So they've been selling boats for, a really long time, multiple decades. And so they have all of this data. And so we need to figure out how critical each one of those, annual or quarterly or monthly, how critical those are. And then, of course, what those distributions are and the range of outcomes. So, this makes perfect sense, right? If you have this much in your data set, then you might need, just a few simulations. But if you have this much in your data set, then you're going to need a bunch more. Let's look at this LOS about probability distribution. So this is what I was saying just a moment ago. So historical data. So let's go back to Malibu Boats. So it's got 40 years, let's say, revenues and expenses and beta and all that stuff. And of course, this is internally generated data. So, boy, it's a long history, right? And it's reliable because, it's a company resources. Now, one of the challenges of using historical data, especially if we go back 40 years, we're saying something like, okay, those distributions that applied for those 40 years are going to apply not only for the next 40 years, but for, this next time period. So that what we're trying to do is we're trying to use that Malibu boat historical data to help us estimate cash flows for our golf cart new product line. So we need to make certain that we understand that we're assuming that there are going to be similarities, in fact, identicalities, is that a word, from history to the future, and it can be applied from the boat industry over into the golf cart industry. Now, the next probability distribution that we can estimate is using cross-sectional data. And so this is a great application for my example. So you think about, we're trying to make this capital budgeting decision for golf carts, and we're using boat data. All right, so there might be correlation, but there might not be substantial correlation. So let's use cross-sectional data. Let's go out and try to observe and collect data on all of the golf cart companies inside of the United States and also outside of the United States. So used when historical data is unreliable. Well, we know our data is unreliable. We know it's unavailable, but it might not be perfectly applicable to golf carts, right? So look at the second circle point. It involves the use of related or peer variable values. That makes perfect sense then, right? And then what happens if we don't like our historical data or our cross-sectional data? Then we can use some kind of a statistical distribution, right? So what we're going to do is choose distributions that capture the variability of the input, and then we'll estimate those distribution parameters. So think about, we have the historical data, we have our cross-sectional data, and if we don't like those or they're not reliable or as available, well, then we can take a step back and say, all right, golf cart distributions. What are revenues distributions? What are they likely to be? Expenses and beta and all those variables that we're considering. What are those distributions likely to be? So we need some kind of fundamental economic and statistical underlying theme to be able to come up with that probability distribution over on that far right column. Here's this exact LOS. Describe how to treat correlation across variables. All right, so the first way, first of all, you have to determine whether there's correlation or not. And that really brings in the specter of what does highly correlated variables mean? Is it 0.99? Clearly that's highly correlated. Is it 0.9? Is it 0.85? Is it 0.8? Is it 0.7? And I'll leave that up to you to try to figure out what is that cutoff point for high correlation and non-high correlation. But when you take exams, I would think that the CFA Institute would make it clear. If they put like a 0.73 in there, you'd scratch your head and say, well, maybe not. So I'm guessing they would say 8.5 or 8.9 or 9.1 or something like that. All right, so once we establish that we have high correlation, then we need to pick one of the variables, right? So that's what that earlier slide said, the one that had the most substantial impact. Or we could model the correlation into the simulation. Now here, this has nothing to do with the reading, but I'm going to go ahead and tell you there are a couple of different ways to do this. You can use multivariate distributions, and that's a really cool way of thinking about it. Let's put our golf cart example here to the side for just a second. I think this adds value to your understanding of this particular LOS. Let's suppose we're a fast food restaurant, and we want to estimate hamburger revenues and French fry revenues, right? And there's probably lots of correlation there because people come into our restaurant and they say, hey, give me a burger and give me some fries, right? Some people come in and say they just want one or the other. So there's probably lots of correlation there. So the wrong way to do this is to estimate these independently of each other. So you need to model those. So you do a multivariate distribution. So you just combine them. Another way is to use what's known as a copula, and these are really, really cool things in risk management. You use these, you use a marginal distribution for the hamburger and the French fry revenues. And so I guess to answer this question on the CFA exam, you would have to know to model the correlation. But if you think of multivariate and you think of copulas, I think that'll add value to your understanding. And you never know what you're going to get inside of that vignette. Remember, that's going to be, maybe an entire page. Hopefully that'll help. Boy, as a test creator, this LOS really sounds like this is a great one here. Describe advantages of using simulations in decision making. So you can envision a scenario under which in the vignette there's a simulation and it's described, and one of the questions is, the advantage of doing this is the following. And so here, what do we have? A better input estimation. And the reason that this is true is because as the crafters of the simulation, you're forced to think about the distribution of revenues and expenses and beta and all those input variables. And so when you think about the distribution, let me go ahead and just draw a bell-shaped curve if in fact that's an accurate description of the distribution. You really are, let me put my arms out here, you're taking ownership of that entire distribution. Dare I say you're becoming intimately involved with that distribution of that particular variable and all the variables. So in the end, when you say net present value is positive, therefore accept this golf cart new product line, you know all the stuff. You've gotten your fingers and your hands into those distributions, and you can make that decision with much more confidence. And then, of course, it generates a distribution of outcomes rather than just one. Like on my undergraduate exams, I give students an initial cost, I give them cash flows, I give them a weighted average cost of capital, and they come up with a net present value. So that would be a point estimate, and they'll say either, therefore accept or reject. But imagine now running this simulation and your arms are all around it. The point estimate, of course that's valuable, but what's around that point estimate has even greater value to the capital budgeting decision. Disadvantages doesn't mean that we're automatically going to make a better decision. And one of the big risks, and I'll show you this explicitly in a couple of slides, is that risks can be double counted. And of course, if you double count the risk, then if you double count any variable, you're going to make a mistake in the decision. Simulations may or may not generate better expected values. They may or may not. The idea is that they will, but it's not a guarantee. How about some constraints? Let's go back to my Malibu boat example. Regulatory capital requirements. So this is mostly for banks and insurance companies. So Malibu Boats probably doesn't have a regulatory capital requirement, but just imagine a government agency coming in and say, okay, boat manufacturers have to have a book value of, some minimum number. What you would have to do then is that you would have to impose that regulatory capital requirement into the simulation so that when you reached into that one particular silo or a bunch of other silos and pulled out values, they would have to be consistent with that capital requirement. Same thing with negative equities. Lots of firms have negative equities, and some countries impose requirements. Like if you have a negative equity value for a period of, let's say, 1 month or 2 months, then you have to restructure the capital on the right-hand side of your balance sheet to make it look like this and this and this. So you would have to put that into each of those silos. So the hand that goes in can't pick that particular value out because it would violate those constraints. And it's similar with earnings and cash flow constraints. These might be imposed internally, they might be imposed externally. And one of the things we'll talk about in future study sessions are, capital structure and leverage and bond issues and all of the covenants that show up in the bond indenture. And then finally, there might be some market value constraints on well, we had the negative equity right up at the top, but now we might have some constraints on market values of debt that might relate to financial distress or bankruptcy. So that, what happens is that, once a firm hits bankruptcy and it has to go through all the proceedings, then it doesn't make any sense to reach in and pull out and say, oh, revenues are going to be $1 trillion, right? Describe issues. This is an obvious notion, I think. Garbage in, garbage out. We've heard about that ever since the beginning of time, or at least the beginning of computers. I remember being in, first time I ever heard it was when I was probably a junior in college, and I had a computer programming class. I mean, imagine how crazy this was. We used to have to sit at a machine and type a line and hit print, and this index card would come out, and then we'd have 1,000 index cards, and you have to run it through a mainframe. And I remember thinking, gosh, I could type anything in there and it would come out. And sure enough, my professor said that garbage in, garbage out. So I've heard about that for a long time, probably longer than many of you have been alive. Look at that circle point there in the bottom. Real data rarely fits a statistical distribution. And so this is a big challenge that, you think you might have a normal or a nearly normal distribution. And in fact, the near normality, even if it's nearly normal, you might have some of those outliers. You might have kurtosis, you might have skewness, you might have all these other things, which would lead to poor decisions in the end. Non-stationary distributions, of course, we talked about this just briefly. Historical data, right? That market structure does not change. So Malibu boats, if it had a normal distribution for revenues in the 90s, does that mean that golf cart revenues are going to have normal distribution in the 2020s? I don't know. It might, but probably not. And then dynamic correlations. This is what we learned back in the 2008 financial crisis. Everyone was saying diversification, but then we have this crisis, and all the correlations shoot together to be near one. So just when you needed that diversification, these dynamic correlation changes didn't help you, didn't help me, didn't really help anybody. So look at that circle point down there. Correlations must be stable and predictable to be modeled into the simulation. That's why, boy, I got to say this. I have to say this again. That's why the cupulas are so critical as parts of simulation. Let's go back to my Malibu boats example. Cash flows from simulations not adjusted for risk. So let's figure this out here. We need to calculate net present value, and we need to consider risk. So we can do this a couple of different ways. What we can do is we can estimate those cash flows, right? We're just pulling those out. And so we have all those cash flows, but then we have it for year 1 and 2 and 3 and 4. When we discount those, what kind of an interest rate do we choose? Well, we could choose a risk-free rate of interest, right? That makes some sense. Or we can choose a risk-adjusted interest rate. That makes some sense too, maybe even better sense. But here's the deal. If we have cash flows that are adjusted for risk, and we use a risk-adjusted discount rate to compute net present value, well, then we're kind of double counting the risk. And that, of course, is not fair. It's not fair to the golf cart. So, think about it. If we do it up here with cash flows and we do it down here with a discounting, we may get a negative net present value, and we might say, therefore, reject golf carts. Let's just focus on boats. But that might be the incorrect decision. As good as Malibu Boats is at making golf carts, it could be better. It could be better at making golf carts, and it might not know it because of this particular problem right here. So what do these diamond points say here? Risk-free rate of interest is not appropriate for discounting such cash flows. All right, so that makes sense then. Discounted at the risk-adjusted rate. But then, if we compare standard deviations of the two investments, we need to make sure that we discount at the risk-free rate. And so what a lot of simulations will do is with our Malibu boats, so we have these golf carts, right? Let's just suppose it's 4 or 5 years. We'll discount them at the risk-free rate and get one net present value, and then discount them at the risk-adjusted rate and get another net present value. So we have those things separate, and we'll have, I mean, here's the cool thing, we'll have distributions for both of those. And here's a quick example here. Let's suppose we're choosing between asset A and B. Look at the, what is that, the fourth column, expected value using simulation. So 125. So what are we saying here? That if the simulation for A and the simulation for B comes up with the identical estimated value, then we're probably indifferent between those two, choice A and choice B. Notice the prices are both 120, so that makes a little bit of sense. But for A, we use a risk-adjusted discount rate of 12, and for B, we use a 14. And then skip over to the right-hand column. The standard deviation is 14% for A and 17% for B. So if we just look at the right-hand column, so let's pretend those first columns don't exist. If we just look at the right-hand column, we might say something like, oh, that standard deviation for B is 17%. And it's only 14% for A. Therefore, I'm going to, boy, we learned this long time ago, right? What do investors like? They like lots of return, and they like little risk. So we'll choose A. So B is at a disadvantage, just if you look at that simulated standard deviation. So wipe all of that out. Look at the bottom circle point. An investor should be indifferent between those two investments. And then let's look quickly at this last LOS. Notice this really is the only one that has decision trees and simulation. So compare all of these. Here's a super table that you probably ought to memorize for the exam. So there are the approaches down the left-hand column. So the first two are discrete. We said that earlier. Simulations are continuous. Decision trees are independent. Scenario analysis, they can be correlated, right? And then simulations are either complements risk-adjusted value, so yes for all three. And that column there, that second to last column there, that's critical. And that's why these three methods, that these three approaches are so widely used, because of that column right there. But then we need to go ahead and focus on that last column over there, substitute risk-adjusted values. And so notice that simulation, I don't want to say simulation is superior to the first two, but in many cases it can be. But there are lots of great uses for decision trees and scenario analysis. And I think that takes us through our LOSs. Let me just repeat. These LOSs could be called, you need to know everything about simulations. And I think we covered that pretty completely.